Hey everybody, Dr. Phil here. So this is a lecture on accounting in business. So the first thing we're going to talk about, this is a very introductory kind of chapter, is the importance of accounting. Something you should think about because there's a lot of really great careers in accounting to be had. Investment up front isn't terrible, and there's a lot of really well-paid jobs at the end of it, especially for people that go on and get the licenses like the CPA and the CMA, for example. So let's start off with looking at three things: identifying transactions and events. So think about like a business is just really a series of transactions, right? Customers come in, they buy stuff, they pay you, maybe they get it on credit. You got to pay as a business, you got to pay your bills, you got to pay your payroll, you got to pay taxes, so on and so forth. All these things that happen, all these transactions, sometimes we refer to them as like economic events. That's a very accounting term to use, by the way, have to be recorded. So somebody's got to keep up with making sure that all these activities that go on in the business, the ones I just described, and of course others, are being recorded. And they have to be communicated to other people. So then you might say, well, like who? Well, think about all the people that have interest in a business. You have stockholders, current stockholders, you have prospective stockholders, you've got creditors, people that the business owes money to. Think about like accounts payable, notes payable. Notes payable is just a loan if you hear that term. So think like the bank. The business could have bond holders if they've issued bonds. Again, another type of creditors, regulatory agencies. So there's all these people, employees too, right? Shouldn't you be looking at the company that you work for to make sure that that they have the liquidity and to pay you in the short term and indeed the solvency to pay you sort of in the long term. So there's all these people that are interested in looking at companies' financial statements, right? Like, how is this company doing? How profitable are they? What kind of stuff do they own? How much do they owe on that? Right? What's left over after you take out what they owe? These are all questions that routinely come up. So here are some examples. We touched on a couple of these already. Users of accounting information. So again, think about the people who would be looking at the financial statements. Okay. So we've always called accounting the language of business. Why? Because it takes data that people need to know about a business and it communicates to them. It helps them make a decision, right? Do I want to invest in this business? Do I want to loan this business money, for example? Right? Now, what we'll do is we'll take these groups of people that are, sort of interested in a firm, in a business, and we'll kind of divide them into two groups. We'll say people on the inside, internal, and you'll see examples of these here. And then we'll also look at people on the outside, external. So examples of external, again, think about anybody outside the business, shareholders. Lenders is their term for creditors. So again, people the business owes money to. External auditors who are sort of checking the books to make sure everything is as it should be. If we look over here, a couple of examples here, purchasing managers, people like within the company that are responsible for buying stuff, production managers, human resource, you know that all these end with the word managers. And that's a pretty common theme. You could also say employees, again, if employees were looking at the business to see, are they making money? Are they going to be able to afford to pay me? Now, ethics is also important in accounting, because whatever information is sort of issued out and promulgated, it has to be believable, right? It has to, people are relying on this to make serious decisions, right? Like, I want to invest my 401k in this business. Probably not the whole thing, but maybe a good chunk of it, right? So if I've trusted information that turns out to be not true, that has serious ramifications, right? That has wide-ranging implications for potentially, more macroeconomically. Um, we use a term in auditing, which I'll just talk about very briefly here, called investor confidence. People have to feel good about investing money. If they don't, then that can cause things like recessions, for example. So what we see here is number one, identify ethical concerns. Number two, analyze options. And then number three, make an ethical decision. This is one, two, and three is no different to what all of you do, probably on a daily or weekly basis, right? You run into some issue, maybe you've got a couple of choices, and okay, which one is the ethical choice for me to make? So we talk more about this in sort of auditing classes, but it's a good introduction to it here in the context of ethics, the fraud triangle. So what we're saying really here is what we're postulating that in order for fraud to occur, generally speaking, these three things are going to be present. Will they always be present? No. Will there be an opportunity? Yes, there has to be an opportunity. Like, for example, if somebody's going to steal cash, like an employee is going to, steal cash from a business, they've got to have access to the cash, right? They've got to have the opportunity to steal it. Now, will there always be rationalization? Most times, probably yes, but some people, their brains just don't work like that. So, I think that's a sort of a psychopathic kind of trait where they're not worried about trying to make themselves feel better about it, right? They're not worried about rationalizing it. And then pressure. People have kids in college, they've got a lot of bills, maybe they can't afford to pay those bills. So, there's sort of like mounting financial pressure on those individuals. All right, the next thing we should talk about is what we call GAAP. Now, we always think of GAAP as, of course, the clothing store. We're going to add another A in, GAAP, generally accepted accounting principles. All right, so this is a term, if you're an accounting major, or even just a business major, you're going to hear this term a lot in every accounting class you take. All right, so when we think about GAAP, generally accepted accounting principles, we're basically talking about like a framework, like if you do business in the United States, then these are the rules that you have to apply. These are the rules you have to abide by, right? Because if everybody just made up their own rules, it would be very hard to compare companies, right? Like it would be very inconsistent, right? One company would calculate their cash balances, this times this minus that. But then company B says, well, we don't do it like that. We, this multiplied by this divided by that. So it would be very hard to compare companies. Now, why do you care about that? Because as investors, as creditors, these are things that we're doing. We're looking at companies. We're saying, well, we have scarce resources. Where are we going to allocate those resources? So we need to know, one, that we can trust the information, goes back to the ethics piece. And two, we also need to know that with respect to the framework, everybody is using the same framework, which here in the US, everybody is using generally accepted. Well, there's some exceptions like governmental entities, but certainly for-profit companies are using generally accepted accounting principles. So who sets GAAP? So who decides what this framework should look like? So the answer to that is the Financial Accounting Standards Board. That's another term you're going to hear a lot of in this class. Or I just abbreviate it, FASB. So if you ever hear me in a video say FASB, then I'm just talking about the Financial Accounting Standards Board. The authority given to the FASB it actually comes from the SEC, the Securities and Exchange Commission. The SEC, as you may or may not know, is a government agency that does other things too, a lot of security stuff, but oversees GAAP by companies that sell stock and debt to the public, right? So think of it like this. The SEC says, okay, well, really we have the authority to set GAAP, but we don't really know enough about it, so we've sort of set up this quasi-governmental agency, if you will, the Financial Accounting Standards Board, cross-representation of industry, academia, regulatory agencies, etc., and we're going to let them take care of that. Okay. Now overseas, there is what we call the International Accounting Standards Board. They are headquartered in London, England. And this is pretty much the standards or the other framework that pretty much I think 110 countries in the world now use. The idea was to sort of try to standardize and harmonize accounting standards globally. Mostly the same as the US GAAP. In fact, there was a convergence project that began, I think, in maybe 2001. It's called the Norwalk Project, and the idea was to try to harmonize US GAAP here in the US, and then international financial reporting standards, or sometimes we just abbreviate that IFRS or IFRS. You can say either way. To try to make sure, because capital flows all over the world, right? It's not like you're just going to invest in US companies. You might want to invest in a Brazilian company or a South African company, right? Or an Eritrean company, right? So you need to know that what framework are they using, and if there are differences, we need to know what those differences are. So the next thing we'll talk about is what we call the conceptual framework. So it's kind of broken down into a pyramid, as you can see. We have objectives. So the objectives are to provide useful information to investors, creditors, and others. Again, think about those people that are scrutinizing, analyzing, looking at our financial statements. Qualitative characteristics. Information has relevance and faithful representation. Faithful representation being it's basically accurate, like it's truthful, and relevance is it has to be The information that's promulgated has to be relevant to the decisions that people are trying to make. So, for example, we want to know, should we lend this company money? So let's look at their liquidity. Will they have the ability to, in the short term to make payments on the loan back to us? What about solvency? How does their long-term stuff look? What are their retained earnings like, for example? Elements. So the elements define items in financial statements. We'll talk more about those later and also in other videos. And then recognition and measurement. So the criteria for an item to be recognized as an element and how to measure it. So that sounds complicated. It's really not. They just basically mean, well, what's the criteria for something to be an asset? What about a liability? What about equity? And speaking of assets, think about all the different types of assets a company might own. Cash, right? That's easy to categorize, right? What about property, plant, and equipment? What about accounts receivable? What about intangible assets? So these are all types of things that we have to determine how to recognize and indeed measure. So really, four main accounting principles you also should know. The measurement principle is also known as the cost principle. The accounting information is based on actual cost. Actual cost is a bit why? Because it's considered objective. So, for example, if we go buy a truck for our business and we spend, we drop 20,000 on the truck, then the measurement of the value of that truck is the 20 grand that we dropped. And that's why they say it's objective, because we're not trying to guess it. We can look at what we paid from that truck from the dealership or wherever we bought it from, and we know exactly what that cost was. Number two, revenue recognition principle. So recognize revenue when goods or services are provided to customers and also at an amount expected to be received from the customer. So what they're basically saying there is we're going to recognize the revenue when we pretty much typically when we ship the goods out, and we're going to recognize it for the amount that we can reasonably expect, which should almost always be, the agreed upon price. Expense recognition principle, also known as the matching principle. A company records its expenses incurred to generate the revenue reported. Now, we'll say this, if you're an accounting student, an accounting major, understand the matching principle, because a lot of times in a principles class, it's just like one more thing they throw at you and it's can kind of get lost by the wayside. But I will tell you from personal experience, the more you understand the matching principle, the idea of we have to match revenues with expenses in the period in which they're sort of earned or incurred, the easier accrual accounting will become for you, or just accounting in general. All right. So don't don't kind of pass this one over. If there's one thing you need to learn to help you through all your accounting classes, it would be the matching principle because you're going to hear things like depreciation. We buy a piece of equipment, and why are we like expensing it over time? The answer is the matching principle, right? So you take the time to learn the matching principle, especially if you're an accounting major. And then finally, here we have the full disclosure principle. A company reports the details behind financial statements that would impact users' decisions in the notes to the financial statements. So we can kind of think of the notes as more like the qualitative piece. So think about we've got quantitative, right? Like the numbers, those are the financial statements themselves. And then we've got qualitative, all the things that come behind that. Some accounting assumptions. There are a few going concern assumptions. So the going concern, it's actually a British term. It just basically means that unless we have evidence to the contrary, the company will continue to exist in perpetuity. The monetary unit assumption, just think about when in Rome, do as the Romans do, right? If you're dealing with a US company, then the assumption would be that you talk it's denominated in transactions are denominated in dollars as our account balances. If you're Brazilian, it would be the real. If you're, China, it's the yuan, so on and so British, it's the pound, sterling. The time period assumption, the life of a company can be divided into time periods such as months and years, just like we do, right? If you really think about it, time is just a continuum, right? It just keeps going. It was humans that decided, think about like the Gregorian calendar, the Julian calendar that we now use. Um, that we've made those periods, right? Like a day is 24 hours. Why? Because we decided it was. Like a week is 7 days, right? 52 weeks in a year. Why? Because we've kind of broken up this continuum of time into those artificial time periods. And then finally, the business entity assumption. A business is accounted for separately from other business entities, including its owner. Now, I will say not every business owner does a great job of that. I am a business owner, and I will tell you that I do keep my stuff separate. Um, But there is temptation there, especially for tax purposes, that somebody buys something for the business because they can write it off, but then use it in their personal lives too. So they're just saying that you need to keep those separate. What you're seeing here is different types of business setups. So you could be a sole proprietor, that's just you on your own. You could be a partnership where a partnership doesn't just mean two, by the way, as it says it means two or more. Um, Corporation is a little more complicated to set up, but this is where you get into like having shareholders. Typically, that's more complex. That's a lot of people that have different, varying levels of ownership. And then an LLC, that's how my company or companies are set up. That's a good way to go because it's easy to set up. You can do it through the Secretary of State's office. It's very quick. It's pretty inexpensive. There's not a lot of red tape and reporting requirements that are associated with corporations. The only other thing I'll say about this one is we live in a very litigious society, right? Like people are always trying to sue each other people are always trying to get something from nothing. So if you decide to set up a business, be very careful with which one of these you use. I would recommend staying away from sole proprietorship and partnership. Why? Because you notice it says unlimited liability, right? You notice corporation and limited liability company, as the name suggests, both say limited liability. All you need to know there is if it's limited to the extent of your investment. If you drop $10,000 in a corporation, the most you can lose is that 10. They can't come after you for your house and car and stuff like that. They can in a sole proprietorship and a partnership situation. Okay, accounting constraints. So we have what we call the cost benefit constraint. So the information disclosed must have benefits to the user greater than the cost of providing it. So the idea of cost benefit is pretty simple. It's something you all do. You're in school, so you have presumably thought about this, right? You're thinking, right, well, I've got to spend money and time on my education. There's perhaps an opportunity cost associated with I'm either not able to work or can't work as many hours or in a not as well of a paid job. But you've reasoned that it's worth it because, once I get my degree, I can go out and make more money. So it's worth, the benefit will be worth the current cost. The materiality constraint, when we say material, we just basically mean if something is material to something else, it factors into the decision. So like if I'm gonna leave here today and I'm gonna go drive to Delaware, for example, then I might say, okay, well, what is the cost of gas? If I get up to Delaware and it's $5 a gallon, then down here in North Carolina it's about 3.30 right now, 3.29. I might say that's too expensive. I don't want to do it. That'd be material. If I look up the weather in San Diego, that's completely irrelevant, right? 'Cause that's 2,800 miles away. Has no bearing on me driving the other direction to Delaware. Conservatism and industry practices are also can be considered a constraint also, and that's going to depend on the industry. The idea of conservatism in accounting is kind of a little bit anyway speaks to that litigious society in which I was just referring to. The idea is that you always choose the option that least overstates your assets, and you always choose the option that least understates your liabilities. All right, so this is something that you're going to want to pay attention to because this is kind of the backbone of everything in accounting, what we call the accounting equation. So we have assets equals liabilities plus equity. You're going to get so tired of hearing this if you're an accounting student, or even if you're not, you're going to hear it probably a gazillion times in this class. Another way to say this would be instead of saying assets, and you can write this down if you want, say what we have. What we have equals instead of liabilities, what we owe, OWE, not own, OWE, and then plus equity, what's left over. So think of this as what we have equals what we owe plus what's left over. So good examples of this in practice would be buying a house, right? You buy a house, the house is worth whatever amount, you put a certain amount down, that would be straight away your equity, and then your mortgage would be for the difference, right? And then every time as you're making payments, all this is changing, right? Maybe not the asset side so much, but the liabilities and equity. Every time you make a payment on a loan, on a mortgage, the liability goes down and the equity increases. Then below this, you see the expanded accounting equation. So you see here, assets equals liabilities plus, and you notice what are they expanding? It's the equity. So remember, equity is, from up here, it's what you have left over, all right? what you have left over. Don't forget that. So equity is contributed capital. What that means is basically kind of what it sounds like, right? The money that people have kicked in plus retained earnings. So retained earnings, think about what the word retain means. Retain means to hang on to keep something. Think about the earnings that the business has generated that they have not paid out in dividends to owners or owners' drawings or anything like that. They've kept it within the business. So think of contributed capital, money kicked in by the owners, and then retained earnings as money the business itself has made. And then if we keep coming down, we got common stock. Common stock is what you get when you purchase stock in a business. That comes with voting rights. And then minus dividends, plus revenues, minus expenses. Okay, so think about why dividends and expenses represent minuses, because that is money going out. You're paying money out in dividends, you're paying money out in expenses. And then revenues is money coming in. So let's look at some transactions that'll help to start this make a little more sense. So the first transaction is investment by owner. So Chaz Taylor forms a consulting business named FastForward, and he's set up as a corporation. Smart. Taylor invests 30 grand cash in the new company in exchange for common stock. So the accounts involved are cash because the business is receiving cash, so the green arrow is indicating that's going up. And then common stock is also increasing to represent basically the stock that this Chaz now has. So here we can see it kind of depicted in the part of the accounting equation. So the asset cash, remember assets are everything that we have, what we have. So the business now has 30,000 cash, and equity is also increased on the right-hand side of the equation. Notice the cash was on the left. So the right-hand side of the equation, common stock as part of equity, is also increased by 30,000. So both sides of the accounting equation just went up by 30,000, so it stays in balance. Transaction 2, purchase supplies for cash. That would make sense right after you set a business up. Probably going to need supplies. So let's do that one. So they purchase supplies and they pay 2,500 cash. So the accounts involved are, again, there's always going to be at least two. Cash is going to go down. You can probably guess by how much, 2,500. And the supplies account is going to go up by 2,500. So let's take a look at that. So here you see it, right? So cash went down by 2,500 because Chaz Taylor just stroked a check, said, here you go, here's the money for the supplies. But in return, Chaz got supplies. So what we've done here is we've just exchanged one asset for another, right? We gave up the asset cash, 2,500 went out, but 2,500 of another asset, supplies, came in. So it's basically a wash, right? Sometimes students will look at this and they'll say, well, there's nothing on the right-hand side of the equation. So how is it staying in balance? Well, it is because the 2,500 negative for representing cash going out and the 2,500 positive representing supplies coming in is zero, right? Take your calculator out, just put in negative 2,500 plus 2,500. What do you get? Zero. Or you could do the other way around. You could say 2,500 minus 2,500, of course, will give you zero. So zero equals nothing on the right, zero. So the equation does stay in balance. So this one is purchasing equipment again for cash. Pay attention to how things are purchased, because sometimes it won't always be straight cash. A lot of times they may purchase on credit. So FastFoward purchased equipment for 26,000 cash. So you can probably see where this is going. Cash is going to go down by 26,000 and equipment's going to go up by the same amount. So once again, this is very similar to the number 2, right? The supplies. Cash went down by 26,000. Equipment went up by 26,000. Again, they just cancel each other out, right? Think about it algebraically. There is no net change on the left-hand side under assets, and there's nothing on the right, so the equation once again stays in balance. Think about number 2 with the supplies and number 3 with the equipment, as we're just substituting one asset for another. And this is not something that you are unfamiliar with. You do it all the time. You go to the grocery store, you substitute the asset cash for the asset groceries, right? If you go to the gas station, you again substitute the asset cash, your cash goes down, and then what do you get? You get the asset gasoline or diesel, right? Depending on what you're driving. All right, what about buying supplies on credit? So now you notice it's not cash, it's now credit, right? So FastFoward purchased supplies of 7,100 on credit, right? So here, the supplies account is going to go up, and accounts payable, a liability is, and we'll talk about a little more about that in a second, is also going to increase. So you can look at your accounting equation, number 4, you can see supplies went up by 7,100 because the business now has 7,100 of supplies that were just incoming. And then we have accounts payable, 7,100 under liabilities, right? So think liability accounts payable, think of accounts payable as the accounts that a business has that it has to pay, that it hasn't paid yet, it's got to pay in the future, right? The word payable represents future tense, right? Doesn't sound like we've already paid it because we haven't. We're going to have to pay it in the future. So the equation stays in balance because the asset account supplies went up by 7,100, but on the right-hand side of the equation, the liability account, accounts payable, also went up by 7,100. All right, what about provide services for cash? Most times when you see it says provide services, they're just really talking about revenue. So it says FastFoward provided consulting services to a customer and got 4,200 cash immediately. Okay, so cash went up by 4,200 and revenues, which is an equity account, went up by 4,200 as well. So let's make sure that's the case. Yep, there is number 5. Cash went up by 42 on the left-hand side of the equation. And then revenue also went up by 4,200 as part of stockholders' equity. All right, transactions 6 and 7. So this is payment of expenses in cash. So it says FastFoward paid rent of 1,000 and salaries of 700 to the employees. So cash went down, just like when you pay your water bill, you know, your electricity bill, your internet bill, whatever cable. Obviously, your balance cash balance goes down, right? Same with the business. Cash goes down, rent expense goes up, and salaries expense go up, and this causes equity to go down. Now, what I want you to understand here, and this again, this is important if you're an accounting student, pay attention to what I'm about to say. There is an inverse relationship between expenses, all right, going up and equity going down. So think about it like this: if you increase an expense, your equity goes down. And right now, you're probably like, dude, I have no idea what you're talking about. Maybe you do, but think of it like this: let's say that you get something in the mail from, let's say like Verizon, right? Let's say your phone bill is with Verizon. And they say, well, thank you for being a value customer, which, by the way, life will teach you. Anytime somebody says thank you for being a value customer, there's what's about to follow is usually you're going to get screwed. Let's say that they're like, well, we're going to increase your phone bill from 50 bucks to 100. No change in service. We just, for whatever reason, it's going from 50 to 100. Well, obviously, you're not happy about that, right? Why? Because once you've paid that extra 50 bucks every month, you're going to have 50 bucks less in your account, right? And it's the same thing as this. When an expense increases, your equity, what you have left over, goes down, right? No one's happy when a bill goes up because they know that they'll have less money left over afterwards. So again, think about that inverse relationship between an expense goes up, think about the Verizon phone bill example I just gave you, and equity goes down. So here you see it, right? So number 6 and number 7, look under assets. Cash went down by 1,000 and then went down by 700 to pay the rent. The rent was $1,000 and the salaries of employees were 700. And then you see over here it says expenses. Now notice that they're in parentheses, but that really speaks to equity overall, right? The expenses are actually being increased. The reason the parentheses are there to denote the negative is because it's speaking to equity overall. All right, transaction 8 provides services and facilities for credit. So the company FastFoward provided consulting services of 1,600 and they rent facilities for 300 to a customer for credit. So accounts receivable is going to go up. We'll talk about that more in a second. Consulting revenue is certainly going to go up. And then rental revenue is also going to go up. So let's take a look at the accounting equation. So we'll come back to accounts receivable. Let's start over on the right-hand side first. Revenue goes up by 1,600 because they provided consulting services. They apparently rented out a facility for 300, but this was all done on credit. So the company is owed 1,600 and 300, right? You add those together, there is your accounts receivable of 1,900, right? So again, think of accounts receivable as money that a business will receive, but in the future, right? They haven't received it yet; they'll get it in the future. Now, let me say one other thing about accounts receivable, just real quick. And we're almost at the end, by the way, if you're tired of listening to me. One person's accounts receivable is somebody else's accounts payable. A lot of times these intro accounting students go through and they don't make that connection. It's like accounts receivable is like it seems like it's way over here, and then accounts payable is like way over here. Let me give you a quick example. Let's say I lend you 20 bucks, like today. And today is I'm embarrassed, I gotta look at my phone. It's August the 4th. There we go. So let's say I give you 20 bucks and you say, well, when am I going to pay you back? And I say, well, just pay me back on the last day of August, so the 31st. So if I hand you 20 bucks today, I have an account receivable, right? Because I am going to receive 20 bucks from you in the future. You will have an account payable because you have something that you have to pay, but you don't have to pay it yet. You've got until the end of the month to do so. So just understand that relationship between accounts payable and accounts receivable. All right, two sides of the same coin. All right, transaction number 9. We're almost done, I promise. So the client in transaction 8, go back and review if you need to. They're going to pay the. Okay, so it was just the one before. Remember that they were owed 1,900 bucks. Basically, the person's going to cough up the money, 1,900. So obviously they're paying you money, so cash is going to go up, and then accounts receivable is going to go down. So you can see here, cash positive 1,900, accounts receivable negative 19. So we're removing the accounts receivable because that person's now paid you, right? If we don't do that, then the system's probably going to send them letters saying, hey, like, you haven't paid your bill. No one likes to get stuff in the mail or on an email saying you haven't paid a bill when you have. So it's important that that gets removed. Again, just one other thing about this real quick. Both the changes are on the left hand or the asset side, right? Positive 1,900 for cash, money coming in. Negative 1,900 for the lowering the removal of that accounts receivable amount of 19. Nothing happened on the right, so 0. These two cancel each other out, positive, negative. Nothing on the right-hand side, so the equation stays in balance. All right, number 10, payment of accounts payable. Now remember, think about the example I just gave you where I lent you 20 bucks. If you have an account payable, you owe somebody else some money. You just haven't paid it yet. So it says FastFoward pays 900 bucks as partial payment for supplies purchased in transaction number 4. So now, if you're paying a bill, obviously your cash balance is going to go down. Your accounts payable balance is also going to go down because you paid off some of the bill. So here you see it, right? So cash negative 900 on the left-hand side, accounts payable negative 900 on the right-hand side. So again, the equation stays in balance. Transaction 11, payment of a cash dividend. Again, that's usually something they'll do at the end of the period once they've assessed that we have the money to do this. So it says FastFoward declares and pays a $200 cash dividend to its shareholder. So the accounts involved are cash. Again, they're paying money out. Cash is going to go down. The dividends are going to be increased, but dividends are just like expenses. All right, let me get this right. Yeah, the inverse relationship applies. Just like think about the example I gave you with the phone bill. If it goes up, if an expense is increased, equity goes down. It's money going out, right? When money goes out, you got to have less left over. The same with dividends, right? Just like expenses, when dividends go up, it represents money being paid out to the owners. So again, what you have left over goes down. Okay, and then you see it, negative 200 for cash. And then again, just like the expenses, remember that negative 17? The negative 200, it's kind of confusing the way they present this, but every book does it, so I won't pick on the Wild book. But 200 is represents equity overall. It's really saying that dividends went up that dividends account was increased by 200, then it caused equity overall to go down by 200. All right, the last thing we're going to talk about is the 4 financial statements, just to give you a quick kind of overview of these. The first one, and we always do these in this order. The income statement is just going to be revenues minus expenses is going to be our net income or net loss if we had more expense than revenue. We then go to the statement of retained earnings. We're going to always start with our beginning balance. We're going to add net income, money coming in, subtract dividends, any dividends we paid out. You don't have to pay dividends. That's a decision that's made each period. And then we have our ending retained earnings. Then we have our balance sheet. Well, the balance sheet is just the accounting equation, right? Think about an equation balances. So anytime you hear the word balance sheet, think about assets equals liabilities plus equity, the accounting equation. And then finally, we'll talk more about the statement of cash flows in other videos, but just know that there are 3 sections: operating, investing, and financing. CF is just cash flow. And then that's just going to tell us each period our actual change in cash. Because remember, cash is the lifeblood of any business. You got to have cash. So here is an example. And if you want to go back, this would be a good instructive little lesson here would be to maybe like pause it right here, go back earlier in the video, and then think about all those transactions. And then all these transactions that we just went through are accounted for right here. Okay, so we always start with the income statement. if we take our revenues, subtract our expenses, we got net income of 4,400, which as you can see is transferred down to net income. The reason that retained earnings is zero here is because this was the first month. Again, think about retained earnings, the money that you're like saving up in the business over time. So 4,400 came in, net income. Dividends, we paid out 200 if you remember. So the retained earnings balance is 42. And then you can see the balance sheet. We've got our assets on the left. Think about the accounting equation. We've got our liabilities and equity on the right-hand side. And then again, this is the same balance sheet. We're just making the point. You can see where we transferred the ending cash balance for December, and we transferred it down to the last day of December, 4,800. And then you see on the statement of cash flows, you can see the three sections: operating, investing, and financing activities. Okay, I know I keep saying this is the last thing. This really is the last thing. ROA, return on assets. So this is just basically an example of an efficiency ratio, like how profitable are we making our assets? Like how hard are they working for us in a sense? So return on assets, ROI, is stated in ratio form, and it's just net income divided by the average total assets. So what we do is we take our net income. There's a couple of examples here: Nike and Under Armour. So fairly good with respect to comparability. We take our, you can see the balances here: 8.4, 19, and then 1.1, 1.3. And then we just divide them out to figure out what the ROA is. All right, that's it. I will see you all in another video. Take care.